Hello there, and welcome to Project Business Basics, designed to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there's a place for everyone on our show. I'm Archit Janarkar, and I'm your host. Today we're going to be talking about several financial ratios, and there are several of these that we've briefly mentioned in some of our earlier episodes, but we're just going to go over and rehash those. So let's get started. Now, for all of these financial ratios that we talk about today, all the parts of the formulas that make up these various ratios can all be found either on a company's balance sheet or its income statement. We've talked about these two financial statements before in the past, so if you want a refresher on that, you can go check that episode out. So this first ratio we're going to look at is operating performance. And operating performance is simply answering the question of how effectively are the company's managers using the company's resources, or rather its assets, to generate profits for the company. And so the formula for this is equal to net income divided by the average assets that the company has. Now you may be wondering, what is average assets? Well, if you think about it this way, when you go and look at a company's financial statements, and let's say that the company has a fiscal year that ends on December 31st. Well, that net income value that you see on their income statement is going to represent the total net income that they've accumulated from January 1st of that year to December 31st. But the number that you see for total assets on the balance sheet is just going to represent the value of the assets that they had on December 31st of that year. But really, when you try to compare that total asset number and that net income number, then you're comparing two different things that are measured by different time periods. So the solution to this is to try and find the average number of assets that the company had during that same period of time that net income was measured. So for example, if we were looking at fiscal year 2020, and we saw that the company reported net income on December 31st, 2020, then we might go and look at the company's balance sheet on December 31st, 2019, and then average that value with the company's total assets on December 31st, 2020. That way we could get an average asset value for the year 2020, and then we could compare that with the net income number that we get for 2020. And when you take that average then and divide net income by that same number, then you should get a value that you can then use to compare different companies and their operating performances. And really what this value is telling you is that for every dollar of assets that a company has, it's generating that much in profit. Okay, now we're going to get into return on equity. And yes, we've talked about return on equity in the past, and if you'll recall, the formula went something like this: net income divided by shareholders' equity. But today we're going to go more in depth into that. And the more precise formula for this is net income divided by average shareholders' equity. And once again, you see that word average is there for the same reasons I just mentioned for average assets and operating performance. So this is measuring that for the amount of money that's been put into the business by shareholders, how much income is being generated from that money. And this is a common number that's often used by lots of analysts to look at various companies. But for us today, we're going to try and break down return on equity into three components: profitability, efficiency, and leverage. So let's look at profitability first. Now, profitability is a financial ratio that's equal to net income divided by the total sales. And this is often expressed as a percentage. It's saying that, well, if a company had $100 of sales, they're not going to get to keep that whole 100. Some of that money of that $100 has to go to buying whatever they sold. Some of that money then has to go to paying employees, some goes to taxes, and companies have lots of other costs as well. So that number ends up coming down, and they end up with a number that's smaller than their total sales. But if they have money left over, that money is known as the profit. And so this profitability ratio is just measuring, okay, what percentage of their sales are they able to keep in profit? Now let's go to efficiency. Efficiency is measuring from a company's available resources, how much in sales is the company generating? So this is pretty similar to operating performance that we talked about at the beginning of the episode. But in the numerator, this time we're not measuring net income, we're instead measuring total sales. So this is a cruder number than operating performance, but it's just trying to determine the total amount of sales that came from all the assets. Okay, and then finally we have leverage. Leverage is referring to how much managers are using debt to increase their assets. And the formula for this ratio is the average value of their assets divided by the average value of their shareholders' equity. And if you'll recall, the balance sheet equation that we've talked about in our previous episodes, assets are equal to liabilities plus shareholders' equity. So in order for this ratio to have a value, a company has to have liabilities. And liabilities most commonly come in the form of debt. So this is just referring to the ratio of assets to the equity. And now let's put these three components together. We're going to take profitability, efficiency, and leverage, and we're going to multiply those three components together. So when we do that, we end up with net income over total sales multiplied by total sales over average assets multiplied by average assets over average shareholders' equity. And we end up with this giant equation and giant formula, but we can cancel some things out because there are some values that are on the numerator that are also in the denominator, such as total sales and average assets, which, for example, is in the numerator of the leverage equation, and it's also in the denominator of the efficiency equation. So when we cancel all these things that can be canceled out, then we end up with the simplified formula for return on equity, equal to net income divided by average shareholders' equity. So let's recap. There are quite a few financial ratios that can be helpful in evaluating companies and comparing competitors. So we first looked at operating performance, which is equal to net income divided by average assets. Then we looked into return on equity. Return on equity is equal to net income divided by average shareholders' equity. But return on equity can be broken down into different components that measure a company's profitability, efficiency, and leverage. Profitability is equal to net income divided by total sales. Efficiency is equal to total sales divided by average assets. And leverage is equal to average assets divided by average shareholders' equity. And when we put the three components together, we end up with the formula for return on equity of net income divided by average shareholders' equity. So the point then of today's episode was to just help you see the way that return on equity can be broken down into these various components, and then you can take those components and compare them across companies and across industries. I hope you enjoyed that episode and learned something from it. If you're looking for recommendations for good investing and business books, I encourage you to check out the Project Business Basics blog and also sign up for the Project Business Basics newsletter. You can do all this through the Project Business Basics website, which is www.businessbasics.online. Also, make sure to check out our social media. We're on Instagram and Twitter with the username at PROJBIZ I'm Archit Janarkar. This is Project Business Basics. Thanks for listening,